So, hello everyone to our Global Claims webinar on trends and developments in corporate insurance losses. I'm Daniel from AGCS Communication, and this is our agenda for today. You see that we start with a very short overview about AGCS and the AGCS claims organization. Then we come to the claims review report and, of course, the top causes of loss that are in this report. And very important maybe for you, at the end we'll give you a deep dive about specific claims issues to watch, and then hopefully followed by an interesting Q&A. And this depends on you, of course, so you can already share all the questions that you have in the Q&A feature here on the right side if you want. And we have a lot of time for your questions after the presentation. Please note that the session is recorded. And with this, I can already hand over to our Chief Claims Officer, Thomas Sepp, that you see here on the slide and also on the small screen here. So Thomas, hello again. And yeah, we are happy to listen to your presentation.
Daniel, thank you very much for the introduction, and welcome everyone who's joining our session today. So quite happy that we have a lot of people attending, and we do hope it's going to be an interesting presentation, which we hopefully will also see reflected in questions you might have that I would be happy to answer. Then once we go through the slides that we have prepared. Before going into the details, we know that a lot of our customers and distribution partners tend to be on those sessions, but we thought nevertheless, let's give it a few minutes to introduce Allianz Global Corporate and Specialties. We have it here on that page, what we are as a glance. Basically, people will know that a leading global corporate insurance carrier, and we are part of the Allianz Group. We are providing different services and products to the world of corporate insurance around property and casualty, alternative risk transfer, but also specialty insurance. We are more than 4,000 people worldwide, plus a lot of support from the Allianz Group. We have 80 nationalities that are working with us, more than actually are present in 30 countries. And we are also, which we are very proud of and would like to do more, a leading international insurance program provider with almost or more than 2,400 lead programs that we operate on behalf of our large corporate, large global customers. We also are well equipped of doing that in the sense that we have market-leading capacity to handle those large risks and bring them to bear in the business. That's AGCS on one page. Given that we're talking about claims today, we thought it might be also worthwhile to spend a minute on the claims function within AGCS and share a little bit about what our claims approach is. Very important, if we talk about that, and you will see that later, our business is strongly a business of large and complex losses. We always know that those losses can be complex, sometimes complicated, sometimes even cumbersome. So it's very important for us as a claims organization and for all my claims teams around the world that we operate in a, we call it solution-oriented manner. We know that things are complex, but we try to work through them with our clients, with our distribution partners to get it to a good outcome. That is underpinned by the capabilities that we have. I would like to particularly highlight our global practice groups, where we have our top experts organized in specific claims categories. For example, we have liability claims, we have recall claims, we have energy claims, and other categories where we know that the knowledge is very important. Aviation is another one to play and help that distinctive resolution approach. We normally provide a good settlement experience underpinned by a positive and I think solution-oriented attitude. And we are offering a number of value-adding services for key clients that are listed here. Now, that is our own ambition. It's also important then to see and understand what our business partners are telling, whether we are living up to that ambition. We have that in the next page from our annual customer survey that we do, but also from broker feedback we have most recently solicited. So if we can move forward a page. Then we will see, here we are, thank you. Then we will see on the left-hand side the Net Promoter Score provided by our customers and broker partners in terms of AGCS versus competitors. What I'm particularly proud of is that if you look at the light blue bar and the black bar, that is feedback on a general basis, and the black one is feedback from customers that had a claims experience. So certainly what we see is that AGCS customers do value the claims experience we provide them, because the Net Promoter Score actually goes significantly up from +5 to +15, where with our main competitors, I think it's a much more mixed picture. And on the right-hand side, I think it's another important element. We have most recently worked with one of our global broking partners, and we did something that we called claims to claims feedback. So the claims professionals in that respective broker house were actually providing feedback to our claims teams, and we asked them how we score on behavioral qualities and on technical qualities in settling claims from their point of view, and compare that to our peers in terms of worst and best feedback, and also whether AGCS would be recommended on their attitude towards claims, particularly right-hand side, where we say, how do you see that, whether we are looking for reasons not to not pay, or we have reliable handling and communication. And we're actually very happy with that feedback. Yes, there's further opportunity to improve. I think some of that I would still like to go up, but it's a good starting base, and I think it's a testimony to all the 600 plus claims colleagues around the world in relation to their work they do every day. With that, that should give you a little bit of a background on AGCS and our claims function, but the reason why we're talking today is the results of our claims review that we're doing. Maybe we give a quick view on the scope of the report. So what we've been doing there is we systematically analyzed insurance claims in the corporate insurance space between January 2017 and December 2021. So 5 years of claims experience in the window of analysis. There are more than 500,000 claims that come from more than 200 countries. And the total value of those claims paid is almost 90 billion euros over those 5 years. Important to understand, we're not only looking at the part that we pay, but there's also obviously payments from other insurance carriers in it that are part of those large insurance programs, being it through co-insurance or reinsurance situations or similar means that we use. That has been the basis of analysis, and also happy to say that this year we managed, based on improved data and analytics, to significantly expand the scope of analysis. What we derive from there are the top causes of loss that we find in those different claims we're looking at. Now, this year, we were actually quite keen to understand it because a lot of things have happened in those last 5 years. To name a few, I think a lot of people will be aware of the significantly changing landscape in cybersecurity, and the relevance of cyber attacks we have seen, in particular throughout the last 3 years, with a significant increase. We all remembered, I believe, quite well that we have 2 years of lockdown and COVID periods, home working and other situations behind us that had significant impacts on many industries, being it aviation, being it entertainment and hospitality, but even being in supply chains and production facilities that people were not able to access. We had things like the disruption in supply chains. We had a continued and sometimes even quite, I think, somewhat between surprising and concerning developments in the NatCat space. And then we had a number of, I think, high-profile things like the Suez Canal blockage that resulted, or we expected, which result in some influence in the pattern. So based on that, we actually said, what are we going to see this time? And I'm afraid to report that it's still the good old boring stuff that is the biggest driver of insurance claims in the corporate world. We have it on the next page. What are the main driver of it? And have a quick look. So biggest one by a long shot is the cost of claims related to fires and in relation to explosion that account for more than 20% of that 88 billion that we referred to earlier. The number 2, natural catastrophes. Third one, faulty workmanship and maintenance. I often mentally combine that with the defective products further down the line. Then we have aviation, collision and crash, machinery breakdown, and then smaller things like shipping incidents, damaged goods, negligence, and water damages. That overall is, I think, more than 75% of the money that was paid out of those 89 billions go into that top 10 causes of risk. So in a way, not too surprising because it's a continuation of what we have seen in the past. But I think there are a couple of interesting things we come to later on that we definitely also identified throughout the course of that work. But is that picture now consistent around the world, or does it vary by geographies? We also did look into that one, and to no surprise, you will see that it is a fairly consistent picture around the world, with either fire or nat cat being top of the list, and then followed by other things like just swapping UK fire first, storm second, US natural catastrophes first, and the hurricane as the main driver of that. There are a couple of more specialized situations like, I don't know, Brazil, for example, that I would basically account to the fact that we're looking also mostly on our data, and that is a little bit reflecting our footprint of business that we have in Brazil in particular. But overall, it's a pretty consistent picture that top 10 causes or top 3 causes that we listed on the previous page are very important and can be found almost in any geography we looked at. Now, maybe we take a little bit of time and talk through the top 3 risks that we have identified. Let's start with the first one, which I think everyone remembers, is fire and explosions. Interesting, maybe here, we said that already 21% of the value of the claims. And fire is responsible for 13 of the top 20 loss events analyzed, if you exclude natural hazards events. It's worth about almost 20 or 18 billion here, to be precise, in terms of premiums paid. And we're also seeing that severity, so the average cost of such a claim, is going up. Drivers for that are higher property and asset values, also more complex supply chains that then driving business interruption situations. And also a concentration of exposures that we have seen reflecting also then higher values in one place. Very important, and we talk about that more specifically later on. We see also that inflation will drive the outlook up going forward, particularly for fire-related claims, where it goes in relation to asset values, but even more in relation to business interruption. But we will talk more about that in the next chapter. Our number 2 is natural catastrophes, where we see that losses continue to rise. It's, as you have seen on the bar chart, our number 2 was 15% of the losses. If we drill down a little bit more, what is below that? It's firstly hurricanes and tornadoes, secondly storms, thirdly floods, and we have frost, ice, snow, and earthquake and tsunamis. What we have seen in 2021, I think, was quite 2 remarkable events. I think people will mostly remember. One was, and that's also the picture on the right-hand side, the Texas big freeze, where we've seen snow, ice, freezing weather in Texas where you would not expect it. And if people remember maybe the headlines on that one, there was a week where the temperature in Texas was lower than the temperature in the Arctic. So quite unusual situation. A little bit similar to the German flood event that we had in the Ahrtal and in a number of other areas, where significant rain was creating flash floods and river floods, but also driven by the fact that the rain situation did stay on the same place for an unexpected long period of time, therefore disposing so much more water than anyone thought before. So probably 2 things to highlight, because I think they go into the category of the concern that resides from the ongoing situation in climate change, that we see more unexpected and unusual natural catastrophe events. Also, that, similar to fire, contributes to a higher degree of business interruption, particularly in property. And maybe last but not least here, also to give some numbers, we have seen over that 5-year period that the average business interruption claim in property actually went up quite a bit, from 3.1 million on average 5 years back to now 3.8 million on the most recent numbers. So here we clearly also see in our numbers that the average severity, so how expensive a particular claim gets, is actually going up. Our number 3 cause on our ranking was faulty workmanship and maintenance incidents and issues. They are the third one with 9%. And the costly incidents include collapse of buildings, structures, subsidence claims, but also consequences of faulty work, insufficient maintenance, and insufficient products and components. Here, the losses involve damaged goods coming from different places, storage, handling, loading, or when in transit. Those are the most frequent drivers of claims, accounting for around 11%. And as I said, I always check in mentally defective products in the same category. That would add another 5 percentage points. So taking that together, we would have workmanship and defective products, order of magnitude of 14%, which is pretty close to what we had on the previous page on on natural catastrophes. Now, those are coming from the analysis of the naked numbers and our causes of loss that we do look at. As part of that exercise, we also talk to the claims professionals and look in the data for other trends. So what we always think is important to also point out and talk through is what we call claims issues to watch. Now, we identified a few, actually 6 that we have on the next slide, that we thought we're going to chat through. So in the next couple of minutes, we're going to talk first about inflation, which is a very important topic from our point of view. Secondly, we're going to share some thoughts around supply chains, in particular the implications and consequences on contingent business interruption. We will talk a little bit about cyber. We'll talk about or share some insights on the consequences of the war in Ukraine. And then a little bit in relation to ESG, so environmental, social, and governance topics that also are drivers of loss, and we think they're going to become more material. And last but not least, some observation around legal costs that we have observed. So let's start with the first one, that is around inflation. What we have on the next slide left, we are just listing a number of KPIs, indicators, that we are checking on a regular basis to understand inflationary trends that will be affecting or are already affecting the average loss amount. Among those are firstly the drive that we see on the cost of construction. So construction index, that's here, the index for Germany, has been going up significantly. Actually, it tripled within a year. Yeah, you see it from 6% to almost 18% is a significant increase. And it's coming from a number of drivers, particularly higher raw materials, but also shortage of labors and logistical challenges. Yeah, that shortage of materials also manifests itself in longer repair and construction times. So the indicator we're checking here is what's actually the active container ship situation, where we see that a year back, 20% of the container ships are tied up in traffic, basically are stationary and not on the move. And that has gone up quite a bit also, and important, and people will know that China is a big part of that. So I think last time we checked, that's a couple of weeks back, but if I remember it correctly, there were more than 400 vessels anchoring in front of the port of Shanghai, because due to lockdowns, there was no on and offloading happening, and therefore impacting delivery times and therefore repair and construction times. That's also playing to the longer business interruptions due to disrupted supply chains, where we see that cargo turnaround usually is 50 days, then it went up to 60 days. Currently, we're looking at much longer timelines, 77 days, also due to what I already said, vessels sitting outside ports because there's not enough capacity. Last, on the bottom here, and we talked about that a little bit later, is we also see an increase of professional services that are being used and are required to investigate and also assess and settle claims. Here's just one example where we have the price for legal services, how they compare to a year back. Here it's the indicator in the US, but that's a similar picture that we see in other geographies too. So we clearly see trends driving the average loss amount up. Now, someone would ask them, do you see it already in the numbers? And the answer is yes, we do. We have that on the right-hand side where we investigated a number of claims, which is highlighted 3 here. And that is driving a second concern that we have, that we actually find more and more situations where insureds are facing undervaluation. For example, we have that Mid-Corp United States hotel, recently completed hotel, actually fell victim to a bushfire, was completely destroyed, and the rebuilding of that hotel that was in operation for around a year was actually significantly more expensive than the value we had on schedule. It was almost 80% more expensive, that was required in terms of additional money to rebuild what was there before. We see a similar drive around the marine business when it comes to shipping, particularly vessel values. They are essentially derived not only from the asset value, but also from the outlook of the booking outlook of the vessel. And we see a lot of vessels are currently in high demand, therefore their value goes up. And that's not necessarily reflected on the underlying schedules that we use. Third example would be a property warehouse, similar story, which I would not go into detail, but we clearly see that we see inflation trends on the average losses, and we see undervaluation now becoming very obvious and visible. Therefore, very important from our point of view that we do encourage all of our customers and the companies we work with to review and adjust the value of their assets for their insurance contracts. I think it's in the interest of all parties. It's predominantly in the interest of the clients that they are appropriately covered for unforeseeable events and are not feeling that they are left and out there in the rain. I think it's important for our distribution partners because that's also an important service and element that the brokers do. They work with the clients to get to the right valuation. So they are also very supportive and see that as an important and relevant topic. And also for us, obviously, it's important if we have systematically undervaluation, then the risk of needing to pay more than that was on the contract is going to be rolled over to the insurance industry, and that's not going to be something that's going to be functioning for the long, because it will then have significant impacts on our own profitability. So what we do encourage also as part of the upcoming renewal discussions is to review the underlying values and adjust them where required and where appropriate to really be protected against unintended consequences. And we also see, which we also believe in, if there is no re-evaluation possible, the risk of under-evaluation should not be rolled over one-sided to the insurer. What we will then aim for is that under-evaluation as specific clauses will need to be discussed as part of any renewal in any forward-looking contract. That's some thoughts around inflation. The second topic was that supply chains, particularly with a focus on CBI. Again, maybe CBI, contingent business interruption, for all the ones that might not have the insurance speech handy. We differentiate two situations: normal business interruption, where a customer insures, for example, a factory that has a fire, therefore can't produce. That's what we call a normal business interruption. But as a lot of people on the call will know, you can also insure events at a supplier of yours. So if the supplier of yours has a fire and therefore can't not deliver the agreed goods to you, we call that a contingent business interruption loss. And we have seen that those will be increasing year on year over the past 5 years. And it's probably just an indication of the increasing global interdependencies and the complexity of corporate supply chains. We saw it particularly in the automotive industry, where we have seen several CBI events during the period we analyzed, with the overall growth in CBI claims really being very strong in the last 2 years. One element I referred to already earlier was the Texas Big Freeze event. There were a couple of supplier companies located in Texas, and the fact that they went into a business interruption period themselves had really knock-on effects, particularly on the car and automotive industry in North America that we did see. What else should be said? Loss events can have substantial impact, sometimes in excess of $1 billion or more. So because it's hitting big companies and there are really consequences of not being able to produce. And what we see there's also that it's a consequence of many companies are still relying on a small number of key suppliers. And we believe, and we see that already, there is some rethinking of supply chains ongoing, because those dependency from a risk management perspective are also causing issues for the respective corporations themselves. Number 3, we mentioned in the beginning in terms of trends, the cyber loss events. The only thing we have put here on the next page is the development of cyber insurance claims 2016 to 2021. That's in relation to AGCS. Now, the earlier years, in all fairness, do reflect also a growth of the business and the increasing number of customers in that space. But if we look at 19, 20, 21, those were predominantly a consequence of increasing cyber activity and the rise of cyber ransomware attacks. I think a lot of people will be aware of that, particularly in 2020, 21, that made headline in a lot of places. And we also talked about that quite a bit in numerous forums. And that's a trend that will probably continue to stay on a high level. Now, there was some concern that as a consequence of the Russian hostilities, that number will even further accelerate. We have not seen that yet, but we're also holding our breath. And I think the most important thing there is that we need to see a higher level of cyber protection in many of the corporations we work with. We mentioned that in some other areas. Today, we are declining the vast majority of cyber insurance applications that we get, and we are not uncommon. We also know that that is the similar situation with competitors. So we believe that will stay as a very important pressing issue. It also got reported again as the #1 risk in our AGCS risk report that we do on a regular basis. So that will need to continue work on all parties involved, meaning on the company side to improve cybersecurity standards, but also on the insurance side to make sure it remains an insurable risk, and also on the reinsurance side to make sure we find ways to deal with the capacity needs and also the potential aggregation that could happen in terms of a cyber event, particularly when it comes to supply chain attack. Next topic, Ukraine invasion impact. We all are watching that still on a daily basis and follow the news of that really tragic event, the invasion of Russia into Ukraine. Now, from an insurance perspective, it has been a twofold event. So one side, as a lot of people will know, is that standard policies for property, for example, or engineering, do carry a war exclusion. So under standard plain vanilla insurance contracts, that has not triggered a loss. However, there are a number of specialist markets where this is actually the case. The 3 to mention is certainly political violence, where you can insure the war risk. Then secondly, on the marine side, we did have quite a number of vessels being impacted by the war and stuck in Ukrainian ports. And then last but not least, the aviation market that has or expecting a significant impact due to the fact that the vast majority of aircrafts that are operated in Russia actually belong to Western DC companies and are currently stuck. So there's an intense discussion currently ongoing how that situation will pan out and what insurance claims will actually be triggered as a consequence of the action that Russian airlines and the Russian state took to actually take ownership or re-registration, to be precise, of those planes. For us as AGCS, it's actually so far a minor event, mostly due to the fact that we are not a player in that specialist aviation market in relation to lesser companies. The next topic, very quickly, a few thoughts on ESG risk as a future driver of liability losses. We see quite a number of topics there. So basically, we highlighted 3 here. The first one is climate change related litigation is on the rise and is likely to become a significant cause of exposure for companies and their directors. We expect to see more also D&O related stuff happening, that companies have promised to support certain climate related changes and might not be living up to it or might not be ambitious enough in the eye of certain NGOs or activists or even customers. Yeah, so we expect that's going to be a rising topic going forward and should definitely sit on the risk register of many companies. Another one, which we saw already a number of situations coming through, is the risk of greenwashing, where you actually promise something to your customer base and a company is not in a position to fully deliver on that. We saw that most recently, I think, on the asset side, investment business, where we had a number of situations that we are closely observing. And we also believe that that risk of greenwashing will be becoming more material, and customers and customer protection agencies will be more on that topic, and therefore could be or will be a driving element of situation for corporations going forward. And last but not least, we also think there will be environmental factors that are driving product liability and construction claims, because they're going to be exposed to more extreme weather, and not every product might have been designed with those more extreme events in mind. Then we already moved forward a page about legal cost and derivative settlement. We see a continued inflation pressure and higher severity shareholder derivatives actions, clearly in the D&O area. It was a bit more stable in terms of number of those actions the last year, but certainly the severity keeps going up. A particularly itchy topic is anything in relation to SPACs, so special purpose acquisition companies, that are posing really a risk for the D&O market, because sometimes it's hard to really understand what the promise was in terms of floating it, and then what happens afterwards, which actually opens then a lot of doors for exactly that derivatives action. Litigation risk continues to be a key concern in D&O, including US risks for non-US domiciled companies. That's always going to be, I think, a demanding topic. And last but not least, particularly in the D&O, but not only there, we see a significant increase on the cost of legal and defense for legal support. That might even that had two drivers. I think if you look at the top law firms of the world, they were really trying to continue to attract the best talents in the world, which means they also continue to increase salaries, entry salaries, and subsequently. And we do believe that inflationary pressure will not help that. Yeah, we also saw it in the other areas that we see either rate increases or demand of rate increases from law firms, somewhere between 6 to 10%, that is currently being debated in a lot of different setups. That's what we thought would be very good to share in terms of trends. So let me just recap. So we talked about inflation. We talked about supply chain, particularly under the CPI lens. We talked about cyber, the war in Ukraine, ESG risks, and legal costs. Now, we also said it would be good to step back and draw some conclusions for it. So if you can move forward another page, please. What we think conclusions are for our clients are the following ones. We have them here on the page. So firstly, if you go back, as I said, there's no surprise in the top cause of loss. So we believe good old risk management continues to matter. Think about the protection of asset against fire and the impact of natural perils, not only from an asset protection, but also from a business interruption point of view. And also testing and quality of products and services delivered remains high, because faulty workmanship, insufficient product and services remain amongst the top three causes of what we have analyzed. We talked about inflation. We strongly believe and see it will have an impact. So update as a client your insured values and your business interruption assumptions. Are you still operating in a space where you have the comfort that the numbers you're looking at really give you the protection that you need in case of the hopefully unlikely event? Supply chains need attention in terms of more diversification, not only from a risk management perspective, but also from a geopolitical perspective. We've seen now the consequences of the highly connected supply chains in Russia and to a certain extent also in China. From an insurer perspective, we would like to think and share that contingent business interruptions will become harder to manage and therefore more difficult to ensure, that there's really understanding of the dependencies, what's a tier 1, tier 2, tier 3 supplier, and what is that relation and is it replaceable or not. Then cybersecurity, I talked about that quite a bit, but it needs more and continued attention on a number of areas. And then last but not least, we would suggest not to underestimate the new trends, in particular in ESG, which we shared a little bit, and also corporate responsibility for your supply chain. We see also there more and more activity happening. in different markets. It's a strong variation in which geography you sit, but generally speaking, there's also a trade that a supply chain liability will become more relevant. So with that, I hope the last 30 minutes have been informative for you. Yeah, and hopefully give you some ideas and inspirations. And we'll certainly would welcome and invite for any questions. I'm just checking on the Q&A there. The only question so far is whether we will be sharing the slides. Daniel was kind enough to answer that already with a yes, we will do so. But if there are any other topics, please don't be shy. Key in a question. That's, I think, the format we can offer today. And we would be happy to actually hopefully be able and give an answer to it. Yeah.
Yeah, Thomas, I think there is another question here about ESG.
Yeah.
ESG can also affect D&O insurance and lead to D&O claims, is the question. So if you can answer this, please.
Yes, it can. We believe that is driving that, and I think the climate-related stuff I referred to would be one example. Yeah. So you are promising certain carbon neutral activities or carbon reduction activities, and you are not able to deliver it. That would be seen probably in the D&O space as potential risk of misrepresentation, and therefore could then attract corresponding D&O related action. So yes, we see that. And also if you go back to the latest greenwashing situation where one of the investment funds claimed to invest only into green products, and it turned out afterwards that that promise wasn't fully delivered, I think you're in a pretty similar situation. There's probably a liability topic and a D&O topic.
Very good. And there is another question about ESG. Seems to be an interesting topic for the audience. At the end, yeah, it's a little bit complicated. What sort of product liability claims have you seen within ESG?
Oh gosh, good question. I need to go back. This is something that jumps to my mind. I mean, I remember one that was product and climate related, where certain specifications for paint did not hold. On the pure ESG side, nothing comes to mind at the moment. I have some vague memory of something, but that wouldn't be robust enough to share it. So we probably need to go back and dig it out again.
Yeah, then we come back on this question. Then there's a question here from Mark. I help you a little bit because the overview is not so easy on this tool. How is AGCS working on mitigating their own risks of BI claims?
So, I mean, our business interruption claims, I mean, if you think about who delivers services to us, that's going to be mostly IT services because we don't produce things, right? We shuffle numbers, money, and information. And for that, IT is a critical component. And there again, obviously, we have good IT management in relation to our vendors that we are providing, including security standards, where we have very high standards, and also in relation to cyber attacks, to make sure that we are not being easily attacked through either ransomware or data exfiltration or any other means, including, for example, that we now started to scan our key providers and service partners also on their cyber vulnerabilities. That's just an example. Then obviously we do have other standards in terms of recovery and data redundancy that our IT colleagues would normally uphold and enforce.
Perfect. So the next question I have here is on climate change. Do you believe we shall experience a CAT reinsurance capacity shrinkage, and what could be potential alternatives?
So that's a very interesting question. I think there will be situations where we could experience that. One where it's already real, if people follow the news, is Florida. It seems to be almost impossible by now to get more capacity into Florida net cat covers. So that's a very specific one. But I think it might also go into other areas when a combination of two things come together. The first one is not sufficient prices for the reinsurers. And secondly, if it has very high accumulations. Then I think reinsurers will become more and more nervous that one material event would also put their existence at stake, and that's certainly something that we'll try to avoid to go into that. In terms of alternatives, I mean, what is being used, and maybe we see a renaissance of that more, is alternative risk transfer, being insurance-linked securities, being in alternative markets. There are a couple of companies, vehicles out there in the FILA, for example, that do that. I think we also have been doing it as AGCS to a certain extent around basically securitizing net cat related risks. And I think there will be those areas. But again, I think there the matter will be is then the price value trade-off actually attractive for investors. I mean, for investors in that space, it's mostly attractive because it's completely undiversified risk. But still, the calculation needs to stack up so that they can actually, at least on an expected basis, earn money.
So very good. Quite a lot of new questions coming in. Here is one about examples of severe underinsurance amongst the insured, CBI, for example. Do you have any examples on this?
On CBI, nothing that I would be having top of my mind, but in terms of asset values, yes, we had. I mean, I mentioned a few of the examples earlier. We actually now are running a tracker where we check it, and I think we have about 30, 40 cases on it at the moment where we actually see that relative to the values we had on schedule, the replacement costs that are often insured are actually quite higher. I mean, I think average we're running at about 25% at the moment on that tracker. Now, we also know, to be fair to our large corporate clients, that value schedules are not always super accurate, so we try to look at that as well. But we definitely saw that replacement values, where it's easier to measure, have proven to come up on a more regular basis. I think in CBI it's a bit harder to investigate and actually to track it.
And then we have a question about the current gas shortage in Europe and if this will affect ESG efforts.
So Daniel, the car shortage or?
No, the gas shortage.
Okay, I misunderstood you. Apologies. Will gas shortage impact ESG efforts? I never thought about that. I don't know. I don't think so. I kind of I would really need to think hard about it to see whether there's a connection. Yeah, but we also had in a similar context the question that whether that shortage of gas would trigger insurance claims, and there the answer would be generally no. Yeah, because I think we're not insuring not or late delivery of raw materials typically. Would be same on the shipping side. If shipping arrives late, that's normally not a covered insurance event.
Perfect. Fire-related claims. Do you see any trends on which type of sites, operations that are most impacted?
I wouldn't know. Again, we would need to go one level deeper in the analysis, yeah, and probably have a chat with our risk consulting colleagues, but I wouldn't know, to be quite honest.
Mm-hmm. Okay, then cyber hygiene. Have you seen a decrease in ransomware claims as a result of a better cyber hygiene? Yeah.
No, but again, we're looking here for a correlation that we probably would need large numbers to prove it, and I don't think we're running in that large numbers. Yeah, what we have seen is that a lot of the cyber crimes we experience could have been avoidable with fairly simple means. Yeah, for example, multi-factor authentication, right? I mean, that makes such a difference. And then we had situations where it was originally introduced, then some parts of an organization did find it too cumbersome and decided to discontinue it. Guess where the attack happened? It was in that space. Or another example, we had a situation where an attack went through a server that was patched for multiple cycles and was clearly visible from the outside that there's a vulnerability that is open for an attack vector. So what we see is that a lot of the claims that happen could have been avoided by basic cyber hygiene. So if we flip that argument the other side around, we probably should see a correlation, but we never had the numbers to analyze it that systematically. And if I'm very honest, as an insurer, I would hope I'm never going to get to the numbers to analyze it systematically.
Then we have a question about inflation again? What measures are being taken as an organization towards inflation trends?
I mean, on our side, again, we probably need to differentiate two different. So we also experience inflationary pressures on our own expense base, but that's probably a separate discussion. Now, on our insured base, what we're really trying to do is work with clients to see whether asset values and BI values can be updated. Also, by the way, you should think about deductibles and things like that, because I mean, theoretically, if inflation drives up values, it would be mindful and sensible to also increase deductibles in line with the increase. And then we'll certainly work closely with our clients. As I said, our preferred outcome is that there's a sensible conversation about what needs to be increased. If there is little preparedness or willingness to review the situations, we would be protecting ourselves by aiming to get then underinsurance or average clauses, however you call them, into the overall relationship.
Thank you for this answer. Did we see an unusual number of food processing plant fires? Have we analyzed this impact on food suppliers and costs?
Don't know. Again, we might need to go one level deeper with the colleagues to see whether that can be substantiated. From my vague memory, I did not get that many food-related claims notices on my desk, but that's now a very subjective view. So we probably need to really go in and dig out the data.
Very good. Then another question on cyber. What are the main drivers of cyber claims this year? Is ransomware still the main driver?
Yes, it is. It's very simple to answer. And then, I mean, the second element that goes with it is then, if you look at the impact of those claims, cyber ransomware is the biggest driver, and then the second element to it is data exfiltration that happens alongside it, and also then every now and then resides in penalty payments for the respective companies. What we haven't seen, by the way, we should also say that a lot of third-party damages, so that if you have a cyber incident that then causes damage somewhere else due to supply chain or due to product issues, we haven't seen many of those. It remains predominantly a first-party and own damage business.
Very good. How the inflation risk is impacting in AGCS underwriting decision and claims reserve policy is another question here. So
I think underwriting decision, I already shared our wish for re-evaluation or debate about average/uninsurance clauses. On the claims side, it's two things. On the one hand side, we obviously, on a case-by-case basis, do review the situation, and there's an indication that it costs more, we will put up the claims reserves. And then secondly, the other part falls in the category of our CFO and the actuaries that obviously they monitor inflation trends, and if required, take additional precaution on it, because it would be putting money aside for events that we're not yet seeing. So we call that the IBNR position, where it would be reflected and would be analyzed and taken care of.
Okay, then we have a long question about ESG again and green clauses, development of green clauses, and how the insurance industry could, oh no, I've lost the question, could support the very important ESG agenda. Is it clear, or should I read out the whole question?
No, read it out, please. Yeah, because I think that I could go very different lines with the answer.
Yeah, we have seen the development of green clauses extending cover to assist with more resilient or sustainable repairs. From a claims perspective, what more do you think that the insurance industry can do to support the very important ESG agenda?
I think that's a very tricky question, very demanding. We thought about that a lot, and I mean, we see in the claims side areas where it does fit more naturally. Like, for example, I know a lot of our sister companies invest quite a bit of effort and energy around motor claims, where we think we can do quite a bit, being it so, for example, that your rental car goes electric, yeah, that we encourage more repair instead of renew, and a bunch of other things. I think on the corporate space, exactly, there's that discussion around, can you build back better standards? That's certainly a discussion that is ongoing. The question is, how do you deal with it if it becomes significantly more expensive? Yeah, I think that's an unresolved issue. And then beyond that, I would say overall, Allianz as a company, we also do drive quite a lot of that agenda when it comes, for example, around responsible investment. Yeah, you might be aware of the carbon-related decisions we took, and then also around renewable, carbon-related and future coal production. So we work on a number of levels, group-wide as Allianz Group, then on our side as AGCS, and there are also activities in other parts of our sister companies, as I indicated with the example around motor claims.
Okay, still 3 questions left, but we already still have some time. So, are you aware of a successful recourse claims against product liability insurers following a wild forest fire caused by a product or by the general operations of a company? For example, electricity lines causing fire.
So, but here's against a recourse. Whether you as a company, I interpret the following way, right? You as a company fell victim to a wildfire that was caused by an electric company and you're trying to recourse against them. Would we be aware of that? What I'm aware of, or we are aware of, that there have been situations like, for example, in the US, where electricity companies are being held responsible for causing wildfires by insufficient maintenance. Yeah, that is still, I think, in the courts, and that would then attribute, if it's all confirmed, damage payments to the companies or the individual that had physical losses due to the wildfire. On a particular one-to-one recourse situation, I wouldn't know. We would need to go and check that.
Okay, then we have another question on gas from Russia. Considering the incoming winter, any plans to maintain operational the nuclear plants in Germany? How to deal with this? Yeah.
Okay, I think it's a good question, but I don't think it's a particular Allianz insurance question. So I can give you my personal opinion, but that's probably not the right place to have that discussion.
Okay, then maybe one we can easily answer. Do we expect to see a rise in D&O claims resulting from recession, growing number of company insolvencies, given the pessimistic economic outlook in many countries?
Yes, we do. It's a very simple answer, because particularly when it's non-list D&O for non-list company, the primary risk that we carry is bankruptcy.
Very good. Do you believe that the increase in SPAC formations might have a direct correlation to faulty workmanship claims and defective products?
SPAC to faulty workmanship. That's a pretty wide bridge for me here, so I don't know.
Okay, it's quite a challenging Q&A for you, but you are doing a great job here. And the last question is, in energy and utilities, we are concerned, especially with supply chain issue. Noting the delays in shipping as one example, do you have any other data gathered demonstrating that your average BI losses are increasing in terms of times delay?
Again, we would need to go to the detailed numbers. I mean, maybe another concern that we see there is definitely now from the insurance side, due to the very high prices of energy. In particular, if you see business interruption on energy producing side, that's something we're really worried about, right? Because they're going to have a loss of profit, and frankly speaking, profits are pretty high at the moment. So that's something we do actually monitor very carefully to see what's going to happen to that trend.
Very good. So that was a really interesting Q&A session.
A lot of tough questions, I have to say.
Yeah. They were all happy that you are here and you could answer most of the questions. So as I said, we will send you we will offer you the slides, and also we will the recording will be live in a few days. So if you want to listen to the session again, you can do that again and again. I don't know if any questions are left. Yeah, there is another one. Wait, oh no, it's jumping always. What percentage claims inflation from all factors are you guessing for the next years?
Somewhere between 5 and 10 to give an order of magnitude. And then I should qualify that obviously does vary by line of business, that does vary by geography, but order of magnitude.
Mm-hmm. Okay. Then I believe this was the last question. So yeah, I think I can only say thank you. Everything will be also on the website, the recording and the slides, as I said. Any last words from you, Thomas? Or?
Just thank you very much, and I hope you found it somehow interesting. For us, it's always a good opportunity to share some of the works we do. Yeah, and Daniel, thank you for organizing it, and I wish everyone hopefully a wonderful evening.